This video walks you through the material that's in Chapter 3 of our textbook. You can skip the section titled Multiple Analysis as well as the section titled Asset-Based Valuation. After explaining these methods, the author continues to describe why these methods are not appropriate for what we're doing in this course. So we will jump to the second half of Chapter 3, the process of fundamental analysis. There are 5 steps to fundamental analysis as described by the authors. They make pretty intuitive sense. First step is knowing the business. This involves knowing the company's products, their competition, their industry, management. Second step, analyzing information. Information we're going to be primarily concerned with is the financial statements, but of course we also want to analyze information outside of those financial statements. Third step is to develop forecasts. What we do is use those financial statements for recent periods to help predict financial statements in the future periods. Step 4 is convert those forecasts from step 3 to a valuation. And step 5 is do something about it. Trade on the valuation. Turn that valuation and our hard work in steps 1 through 4 into some good cash. So analysts use the current financial statements to forecast future earnings and other financial statement data, such as future cash flows, future sales, future assets that are used to generate future revenues and income. Valuation models require estimating future payoffs and finding the present value of those payoffs. But what is the best measure of a payoff? Is it dividends? Is it free cash flows? Is it operating income or net income? This class will cover various valuation models and discuss advantages and disadvantages of each. In order to estimate future payoffs, what we really want to do is measure how the firm generates value. And how does the firm generate value? And what the rest of this video is going to do is talk about ways that the firm does not generate value. One of the ways that the company does not generate value is through equity financing. So not from equity financing activities. And we're going to look at why. Share issuances. Share repurchases. Buybacks. And dividends. And also not from debt financing either. This is really primarily issuing bonds. So how does the firm generate value? Operating activities, running the business, and investing activities using long-term assets to help generate returns. All right, so let's start by looking at share issuances in efficient markets. Let's say, let me add some space here. Oops. Let's say that a firm with 120 million shares outstanding issues 10 million additional shares. at a price of the market price of $42 per share. What happens to the price per share? Nothing. The firm's market value prior to the offering, so before the issuance, the value of the firm was 120 million shares times market price of $42 per share, or 5040 million. And what does it look like after? Let's see, we have 130 million shares times $42 per share, 5460 million. And now there are 130 million shares outstanding. So if we take the 5460 and divide it by the 130 million, of course we get back to the same stop price of $42 per share. So the price per share is not affected. Let's go down to this problem we have here, E3.11. Pretty basic examples that kind of show the point how firm value is not affected. A, XYZ Corporation had 158 million shares outstanding. On February 2nd, it issued an additional 30 million shares at a price of $55 per share. All right, so we're going to do the same thing here. Prior to issuance, firm value was 158 million times $55 per share. This is 8.69 billion. The value of the share issue is 30 million at $55 per share. So 1.65 billion. So the total value of equity after the share issue, if I just sum these up, is 10.34 billion. And that is based on 188 million shares. And we can see what is that price per share. It is, of course, still 55. But let's move now to part B here. Give myself a little more room. On February 28, 2012, the directors of the same company exercised stock options, which allowed them to acquire 12 million shares at an exercise price of $30 per share. So here's where this problem differs. We are now allowing some of the directors of the firm to buy shares way below the market price. Why did we do this? We gave them an incentive to work hard and increase the price of the stock. And now that the stock price is higher than the exercise price, they are exercising their options and buying the stock quite cheaply. Prior to the transaction, the stock traded at $62 per share. Question is, what was the effect of the share issue to directors on the per share basis of the firm? Give myself a little more room to write here. All right. We look at the total value of the equity prior to the exercise. So prior to the exercise of the options, there was 188 million, oops, this is not shares, 188 million shares, not dollars, outstanding times stock price we see here of $62 per share, or 11.66 billion. The value of the share issuance to those directors through this option exercise, they gave out 12 million at $30 per share. So we increased the market value by 0.36 billion. So the total value after exercise is, total value is $12.02 billion based on 200 million shares. So what is the price per share after the exercise? 12.62 billion divided by 200 million shares. The new price per share is $60.10. What was the price before was $62 per share. So we can see that the shareholders that held the shares prior to the exercise are now worse off. They've lost $1.90. Previous price minus the new price. They've lost $1.90 through dilution of these new shares that have been issued. All right, next problem we're going to work through, share repurchases. Share repurchases are share issuances in reverse. When a company buys its own stock back at the market price, this should not affect per share value. Here we have an example. A firm with 100 million shares outstanding repurchased 10 million shares at the market price of $20 per share. The question asks, what is the total market value of the equity after the purchase, and what is the per share value after the repurchase? Give myself a little more room to work here. All right, so the market value before the repurchase is simply the 100 million shares times $20 per share, 2,000 million. The amount of the repurchase Remember, when we are dealing with treasury stock, we are reducing stockholders' equity. So we reduce stockholders' equity by 200 million. And the market value after repurchase is 1,800 million. This is based on how many shares? Well, I had 100, bought back 10. So 90 million shares are outstanding. So the market price per share, 1,800 million divided by 90 million. Market price per share is at 20, exactly what it was before. So we see that a repurchase at market price does not affect the firm value. So that is it for our repurchases. A couple comments about dividends. Does issuing dividends affect the value of the firm? If a firm pays $1 of dividends, that stockholder gets the dollar. Dividends. That stockholder gets the dollar, but there's $1 less in the firm, so the value of the firm drops by $1. Shareholders receive the $1 of dividends, but they can sell the share for the $1 or less. The dividend payment makes them no better off. So dividends, cash to investor, cash out of firm. Investor is no better off having that cash dividends. Sure, he can spend the cash, but he could have left it in that firm to continue earning a return. So the dividends payments makes the companies no better off. Many investment textbooks and classes focus on the discounted dividend model. You saw that in the last discounted dividend model. You saw that in the last 2 videos that I posted for this week. It seems like it would make sense. When we value a bond, we take the present value of the future cash flows. So why wouldn't we do the same with stocks? When the cash flows on stocks are those dividends, Well, if we believe that the dividends are irrelevant to the investor and do not add value, then maybe valuing a stock based off of its future dividends, it might not be the next method, the best method. Dividends are simply distributions of value. What creates value is the company's cash flows from operating and investing activities. And therefore, valuation models should focus on the value created from a firm's investments and operations. Next week, we'll begin learning about other valuation models, and we'll extend the discounted dividend model. In the meantime, please get started on your Blackboard homework assignment. That will be due soon. The assignment date will be in your announcement, and next week we will move forward to Chapter 4.